Hello, everyone. Another follow-through day to the upside. Watching the markets sort of drift back above the 50-day moving average, see where the close sort of peters out. But overall, nice recovery. Again, sort of a follow-through from yesterday's up close. We're now back into the range from end of last week, beginning of this week. We'll have guest John Kosar with us, ladies and gentlemen. This is the Final Bar. Good afternoon, everyone. Welcome to the Final Bar. This is Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks, as always, for joining us after the close to unpack the price action of the day and, as much as possible, connect today's price action to the long-term trends. Help understand how this fits into the overall environment. Connect the short-term to the long-term. So today, a bit of a follow-through to the upside. Yesterday, we sort of had that kind of inside close where we traded up, but not meaningfully higher. Today, we sort of had the upside follow through. And again, just based purely on the technical read. What's interesting is if you look about where we close around 29.38, that lines up with this resistance level we've been referring to for a number of weeks now, which is the peak that we saw back in August. A number of times as the market rallied higher, we sort of found resistance there, lines up pretty well with the high from end of April, beginning of May. So that level, that 29.40-ish level, continues to be an interesting point, a point at which we want to take a step back and just see where we're at relative to those previous resistance and support levels. So certainly sort of a follow through to the upside. It's interesting to note that the RSI still, dead neutral, could not be any more neutral. And that's certainly how stocks have felt recently. It's felt sort of decidedly sideways. Looking at the short-term performance today and just where things played out, we had the NASDAQ up almost 0.8%, 0.4 of a percent. The S&P up 69 basis points, and Canada up just up above, a little bit above a flat for the day. In terms of major indexes and sector themes, transport's up dramatically, up 1.2%, so much more than the S&P. Again, we have the situation where it's the largest, most sort of, I would argue, defensive parts of the market, or certainly the largest mega cap side of the market up the most, with small caps continuing to not appreciate to the point that the broad market indexes are. So, not that traditional flood back to sort of the more speculative side of the market that would suggest sort of an all clear bullish signal. Looking at the sectors, energy notably up the most today out of the 11 S&P sectors, followed by financials. So, two sectors, two areas that we've talked about previously, and certainly have seen that up. I'm just realizing, thanks to my producer, I'm not sharing my screen yet, so forgive me for that. We'll fix that problem. Now going back to the table. Sorry about that, everybody. So energy financials up the most. That's sort of noteworthy here. That's a different feel. Energy routinely has been at the bottom of the stack there. Real estate and utilities, followed by consumer staples at the bottom of the list. So that's the area where we traditionally, on the defensive side. So, really sort of a shift of sorts, a follow through to the upside. Consumer discretionary kind of in the middle, sort of a market performer. So oil services names really were leading it, followed by banks and broker dealers. So energy and financials on the way up, and then gold. And we had a great discussion with yesterday talking about gold, talking about a long-term picture on gold with Larry Pesavento. And here we have gold just for today, leading the way lower. Let's dig into some of the charts a little further here. So this is what today's price action actually looks like relative to the previous 4 days. So I like to look at today relative to the last week. So here we have the sell-off into Tuesday's session, the low, we almost closed to a new low there on Tuesday. Wednesday, we recover a little bit. And then here's today's action with the big move out of the open into around 11 down in the afternoon, then back up toward the top. So this is actually the first trading day out of the last 4 that we haven't sold down into the close, which is, maybe an interesting picture. That's when a lot of the institutions are sort of making their moves. So if that's something to celebrate, then we can certainly do so now. I like to look at large versus mid versus small. This is a candle glance looking at a lot of the major indexes. So if you just focus on sort of that center left of the screen where we have the S&P 100, sort of the mega caps, the S&P 400, the mid cap index, and then the S&P 600, the small cap index, looking 1, 2, 3 across the board, we can see how the sell-off over the last month has really been less exaggerated on the mega caps, a little more so at the mid caps, and much more deeply with the small caps. And that's a theme we've talked about now for a while. And on a day like today, as stocks go higher, again, it's not the small cap names that are really leading the way. And if you look, mid cap index, small cap index, still below their 200-day moving average, still below that long-term smoothing mechanism, whereas the mega caps and also the broad S&P 500, above. So certainly not an all clear of sorts, but definitely a move to the upside. In terms of things that caught my eye visually, interesting to see how emerging markets sort of rallied very nicely today. They traded up toward the highs, came off just a little bit at the end, but the EEM, which is the emerging markets ETF, rallied a little nicer. It's still in this sort of congestion range and still below the long-term moving averages. So it's not, a dramatically bullish signal, and relative strength still pretty flat. But again, an emergence of emerging markets, which would have to be driven really by a resumption of the uptrend from commodities, things like oil, which is where a lot of EM would drive its value. Haven't necessarily seen that, but on a day when energy and financials lead, not surprising to see EM look pretty good on a relative basis. EFA as well, sort of trading to new swing highs, closing to a new swing high there, which is noteworthy. So some of the international markets may be looking even a little more constructive than the U.S. markets in terms of the short-term picture. Going to jump over just a little bit to the Mindful Investor Live chart list. We're going to talk a little bit about that later in the session, but I wanted to highlight a chart or two. This is one we referred to a number of times. This is looking at the cumulative advanced decline lines for large caps and also mid caps and also small caps. And I've color coded this just to illustrate how the advanced decliners, that breadth measure from mid caps and small caps, have broken below support. We have not seen that yet from the broad S&P. So again, on a day like today where the largest companies, the biggest names were driving things higher, still with breadth a little more negative than positive for mid caps and small caps. So, until you start to see those advanced decline lines, that breadth line turn higher, it's hard to get too excited about long-term strength of the market. It still feels like, a little bit of a recovery stretch within everything else. I want to finish off by just highlighting this chart down here. This is the relative performance of semiconductors versus the rest of the market. Earlier today, this actually broke above resistance. It settled off a little bit on the relative strength, but again, we've looked at this ratio of the relative performance of semiconductors. Simple ratio of the SMH, which is an ETF tracking semiconductors, versus the broader U.S. market. You can see how the ratio has gone higher and higher. Earlier today, it actually broke above resistance, kind of settled back down a little bit. But boy, that would be an interesting signal if you would see a follow through to the upside on the relative performance of semiconductors. And most encouraging, in my opinion, would be a break to new relative highs for the year, which would mean it'd have to get up a little bit further. And again, that's not telling you that necessarily that's one data point sort of on the bullish side, but in general, semiconductors tend to do well in a bullish tape and they tend to underperform in a bearish phase. So, semiconductors performing well, that part of technology doing well relative to the rest of the U.S. equity market would certainly be a check in the pro column of thinking about further upside for equities. So that's a little run through some of the charts that are catching my eye, thinking about unpacking today's action. What I wanted to share with you next, we have a segment on talking technically. This is a series of really good videos my fellow contributors over time have recorded to sort of highlight how they use StockCharts.com effectively. This is one of my peers, Aaron Swenlin, talking about chart packs in particular. So we're going to hear from Aaron. We'll be back to sort of recap what she said here now.
One of the tools on StockCharts that not a lot of people are familiar with are chart packs. And of course, with Decision Point, we have free chart packs with all those indicators that we cover and that I've talked about in some of the other Talking Technically segments. And so if you want to get those and have all those chart lists to yourself, pre-made, ready to go, everything set up the way we look at it, you can use a chart pack. So if you go just up to your account here, you can go right there to your account, and there near the bottom are the information about chart packs. So I'm going to click on Manage Chart Packs. And as you can see, we have quite a few different ones available. And some cost money, but the majority of them are free. Highly recommend you look at the StockCharts Essential Chart Pack. I think that gives you a really nice framework. And so I highly recommend that. But of course, there we go. Lots of decision point chart packs. And the beauty of them, like I said, is they are going to give you a huge amount of chart lists, and they're already ready to go. So if you come down here, we have the chart pack set up differently. We have some where you go straight into your market indicators, and then we have some where you're looking at just a particular index. It just depends on which way you want to look at the market. Do you want to look at one indicator across all the indexes, or do you want to look at an index and see all the different indicators for it? Well, we have two chart packs for that. So the first one are the market indicators. So in that chart pack, you can see lots and lots of chart lists in here. The McClellan oscillator, for example, is in here. And if you look at it in the summary version, you can see that it's an indicator, and we have all of the NASDAQ, the S&P 500, the 400, all of the McClellan oscillator charts for those different indexes. But what if you want to go the other direction? Well, then you can go to the straight shots or trending condition chart packs. So in the straight shots chart pack, let's go ahead and we'll look at the S&P 600, for example. And there you go. We have all of these different, the Swendland trading oscillator specifically for the S&P 600, and all of these other indicators that we follow very often. And again, there's your McClellan oscillator. So I recommend, if you are an extra member or above, because you need to be able to accommodate quite a few chart lists, go ahead and check out some of these free chart packs. And the beauty is, if you don't like it, they're really easy to uninstall. But I think you're going to really like them.
I thought that was some great thoughts from Aaron Swendland, again, one of the fellow contributors here at StockCharts.com, talking about the chart pack system. And again, one of the things I've always enjoyed about the platform is being able to sort of gain from others that have come before us, and seeing how they use different charts. And I think chart packs are a great way to actually, apply some of the lessons that some of these experts have learned over time. If you're not super familiar with that side of the platform, if you go to your dashboard, your members dashboard page, on the left side of it, there's a whole section called Member Tools. And if you scroll down a little bit, sort of toward the bottom, you're going to see a whole section on chart packs. That'll show you some of the choices that you have and give you a sense of what's out there. And while you're at it, I tell you what, we've done a lot of improvements to the StockCharts platform. In particular, we've focused recently just on this dashboard page and making it, trying to surface more and more relevant information. So things like the sector summary and a new market overview. Also, I have to point out that you can get the most recent blog posts and also a live StockCharts TV feed right from that main dashboard. So we're trying to make it sort of like your go-to spot, your starting point on StockCharts, and sort of building it from there. We're working with a lot of our contributors over time, and I'm sure you've heard about the ACP, the new advanced charting platform that we're in the process of releasing here over the next month or two. You're going to see more and more chart packs and other sort of visualizations incorporated into that new platform. So look for more to come there. We're going to take a quick commercial break. We'll be back with my guest, John Kosar of the Asbury Research. See you in a minute.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have chart school and creative strategy videos to help you become a better technical trader.
leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
Hello, everyone. Welcome back. This is Dave Keller from StockCharts.com. Thanks for joining us today on the Final Bar. Always appreciate it. And want to welcome on my guest, John Kosar from Asbury Research. John, it's such a pleasure to have you on. I've known you for a number of years, followed your work, and excited to have you share your thoughts. Thanks so much for coming on with us.
Happy to be here, David. Thanks for the invite.
So you took some time and sent us some charts ahead of time, which I really appreciate. The first one is looking at the S&P 500 moving averages on a daily basis. What is this telling you?
Well, basically, the first thing that we try to do in our we have a service that provides various types of investment research to different types of investors. And but like the first thing that we generally do is try to take a major chart like the S&P 500 and kind of dissect it, so you know where the levels are, and then we watch how the market reacts to those levels, and then we're also looking at some key market internals that I've been tracking through most of my career. So it's kind of a two-step process. See how the price of the index actually reacts to the level, and then kind of look under the hood of the market and see what the internals are telling you. Is it strengthening there? Is it weakening there? And that kind of helps us to come up with a station-to-station plan on how to trade it.
Interesting. And so it's a great way to think of the relationship of the trend to the long-term levels. What are you seeing right now on what's the take now?
Well, this is quite an interesting chart. I think to the casual observer, it's like, wow, we've been dead in the water for 6 months. But if you kind of see what we did, we really didn't get back up above the 200-day moving average, which we use as kind of a major trend proxy in a meaningful way until early to mid-March. And then we had a nice move up to the May highs. And then there's been a lot of erratic movement. But I mean, I'm just looking at the close today, and we are very close to the May 1st high. We're also very close to the June 21st, August 1st, and October 1st highs. Right. So a lot of gyration in between, but we really haven't gone anywhere. So what this chart is telling me is the major trend is up. The major support level for me, I try to look at things in terms of bands and not just one level or one line, but I try to find a convergence of different things. It could be a Fibonacci number. It could be a moving average. It could be an old high or low. You could see by the chart here, 2851 to 2800, kind of a wide level. I'd rather it be narrower, but it is what it is. That's your major support. We've been sitting on it really since the beginning of August. Primary resistance is 2941 to 54. You've got the September 2018 high, the May 1st high, and the 50-day moving average, all within that tight little 15-point range or whatever it is, 13 points. And then up above there, we have the highs. So to me, we're sitting on a resistance level. If the market is good, you should see the internals get better. If the internals do not get better, this is a likely peak that will take us back down to retest that 2850 to 2800 again.
Boy, so we're really at a crucial level, and this is such a great illustration of maybe that confluence of resistance that you suggested there. Now, the second item you sent was looking at market internals. How does that relate to what we just saw?
Well, that's the under the hood portion that I just mentioned. These are 6 indicators that I've been tracking for really most of my career, along with others. And we actually back tested kind of my favorite indicators and doing this for almost 40 years. And we were testing to see which indicators worked best with other indicators. In other words, to give you kind of a 360-degree picture of the market that just isn't based on price. There is one price indicator in here. We actually call this the Asbury 6. And these aren't indicators we invented, but we kind of paired these together, kind of put these all in the same table because they give you different looks at the market. And when you look at them all together, it's a very good comprehensive day-to-day view of what the market's doing. So we look, the only price-based one is the monthly rate of change. And then we look at a relative performance chart between stocks and junk bonds. You know, this is price. Right. And we look at ETF asset flows. We look at the spider We also look at some others: high yield corporate bond spreads, on balance volume, and market breadth. We have one particular type of market breadth we like, but that gives me a comprehensive idea of what's going on. And this particular metric turned negative, where all six were in the negative column, as of, I think, October 1st or October 2nd. And that was just as we were breaking down through that 2950 area, and we've been underneath it since. So now we're testing it from underneath, and I'm saying, okay, how strong is this thing? Is it strong enough to get back above there and maybe take another run at the highs? And the answer through the close yesterday is no, it's not.
So we're almost out of time, John. I want to make sure we touch on your third chart. We thought it was really interesting. It's the NDX, the NASDAQ 100, but also total net assets on the Qs. How do you read this?
Well, this is another, we use the spiders for the Asbury 6, but I like to look at the Qs because they tend to be, they're a little more high beta, they're a little more fast twitch. So sometimes you get a day or two lead on what you're looking for in the spider ETF data through the Qs. And what the Qs show is our model, Asbury 6 model, actually turned on October 1st, but you can see that we broke down through the 21-day moving average in the Qs total net assets a couple of days sooner, September 27th. The reason the 21-day is that's our tactical time period is 1 month. So 21 days is one business month. So what this is showing you, if you go back across the chart, you'll see the last time that we had this kind of an issue was back at the end of July. I think we peaked maybe 1 or 2 days prior to that, and then we were in the doldrums for the entire month of August. And this was a really good indication that there was money coming out of an ETF that represents the NDX, of course, and you would expect that to lead. If people were excited about the market, you want to see expansion there. And if you go back to the first third of the chart, you see from June 10 to July 30, even though the NDX was going up, those assets were treading water. They were treading water for about a month and a half or 7 weeks or something like that. So that was a little red flag for us. And once they rolled over, according to our tactical time frame, that told us that we were probably in for some tough sledding. And that's when we tightened stops, and that's when we stopped investing in individual stocks, things with higher beta, just to kind of go into a defensive mode.
Right. Boy, it's such an interesting take. And I love the idea. The S&P, as you mentioned, long-term trend okay, but approaching key resistance. But the internals showing a lot weaker. And then net assets, definitely rolling over. Can we go back to just that first chart really briefly? I love the take. What would you need to see, just really, really quickly? What would tell you maybe that it's wrong? What would maybe tell you that things are long and strong, things are fine? Is it a breakout above 2954 or return to previous highs? Like, what would you need to see there?
A breakout above the 2954 area, but I have to have the internals. So much of the day-to-day trading now is driven by algos, and there's a lot of overshoots, as we all know. People are getting stopped out more now than I think they have, certainly 10 years ago or 5 years ago. And a lot of that is all of the algo volume during the day is really whipping a lot of these assets up and down. You're breaking support, and 3 days later, you're tearing it up on the other side, and the opposite for resistance. Right. So to me, I don't think you can look at simply price anymore and say price is all I need, because you get paid for price. You need to use some lie detectors, and I use that Asbury 6 as a lie detector.
That's a fantastic take, John. And listen, really appreciate you coming on the show, and especially you sort of glossed over just a touch, but I love that idea about, it's not necessarily particular specific levels, right? There's a little bit of a give now, I think, in terms of, where the price is relative to those key levels. So I love that. I love that take. Yeah,
that's an excellent point. And that's true now. I don't know that was certainly 10 years ago, that was not the case. Everything seemed to stick. You've been around a long time like I have. But now these levels, they've gotten very, very fuzzy. So you need to bring in other indicators to let you know if that was just a head fake or if it's the real deal. And that's why we're relying on a lot more kind of secondary indicators now than we ever have.
This is great stuff, John. Thanks again for coming on. Thanks for sharing a little window into your process. Really appreciate it.
Happy to be here. Thanks, David.
All right, ladies and gentlemen, that was John Kosar from Asbury Research. Just a really interesting take. And again, that point can't be, I think, downplayed, which was that idea of, having a little bit of a give, a little bit of soft feel to some of those support and resistance levels. Years ago, you didn't really need to do that. but I think that certainly seems to be the case now. What we're going to do now, just to finish off our time together today, go right to the 3 and 3. This is where at the end of every show, we like to take 3 key charts and just highlight them for you. And again, these are not the only charts you want to pay attention to, but boy, if these aren't on your radar, I'd certainly hope you sort of take a shot of them mentally, put them on a chart list that you're following, and just see how they evolve, because I think they're going to be key for understanding what's happening. The first one today on the 3 and 3 is the percent of stocks advancing versus declining. So this is looking at the S&P 500 at the top, a daily chart going back for the last year, and then we have basically the percent of stocks on the NYSE advancing, and then the percent declining, right? So closing down on the day. So it's just how many stocks out of the main exchange are up on the day versus down on the day. And again, it's not a perfect system, right? I mean, it's going to be based on short-term movements, but looking at how we play on certain days relative to where we've been historically can be really helpful. And 2 things I will point out to you. Number one, over the last 2 days, we've talked about this accumulation, right? So we dropped off on Tuesday after a little bit of a stall, Monday and then into Tuesday, Wednesday, Thursday. Now we've gone higher. Look at how much of there was on the selling side on Tuesday on that big distribution day. 3 out of every 4 stocks was down there. But then in the last 2 days, it's been about 2 versus 1, right? So for every 1 stock closing down, there's 2 stocks that are closing up on the day. So it's interesting just to confirm what you're seeing there and see what sort of breadth there is behind each daily move. How many stocks are sort of participating on that up move? What I would also point out is look for like 80-90% days. So that's when this reading gets up to like 0.8, 0.9. I've sort of given you some horizontal lines to illustrate that 90% level. And again, there are a lot of ways to measure this. People will report this in, based on different data points. But for me, it's just a quick visual to see when there is a thrust of momentum on one side or the other. So if 9 out of every 10 stocks is up on the day, that tells you there's a significant amount of upward pressure. So you'll find that sort of like in this phase coming out of the lows in December, the beginning of January, and you see that leads to a pretty good accumulation. And then compare that to the only 90% down day that I'm showing on here, which is that first week in August. That's after that big sell-off, a big distribution. We didn't go much lower than that, but it sort of showed you how much bearish pressure there was, right? There's a lot of negativity. And again, we really haven't gone anywhere since that sell-off at the beginning of August. So that's chart number 1, just the advancers, decliners broken separately. The second chart I want to show you is just a chart of the TLT, the long bond ETF. If you've watched the show previously, I refer to this one often. There's a lot of ways to sort of just get a read on bonds and plenty of ways to do it. I like to just use the TLT because it's very liquid, widely followed, and just gives you a good sense, a good proxy for bond prices. And today was certainly a more of a distribution day, right? Now back below the 50-day. I don't have a chart of the 10-year in front of me, the 10-year yield, but that's back above, reclaim the 50-day from below. So there's definitely this shift of stocks going higher, bonds going lower. So the stock bond ratio that we've looked at, the SPY versus the TLT, went up a little bit because stocks rallied as the TLT sold off. So for this chart, I'm looking at down here at the RSI, now back below 50. And again, I'm looking back to the previous bottom where we got down to around 40, 35. And that 40 level, a lot of times in a bullish phase, ends up being a pretty key support level. So if we do see a little bit of a further downside, that's a chart I'm going to be looking at just to measure how far down we're going. Then the third one is the AAII rankings. These are rankings. These are the American Association of Individual Investors. If you're a member of that, if you're familiar with the group, you can actually participate in the weekly survey. It's every Thursday they release the numbers, and it's, are you bullish, bearish, or neutral on stocks for the next 6 months, if I remember correctly. We just had this week's reading come out. Again, very similar bullish reading, just down a little bit, 20% bulls. But look, it's almost for every 1 person saying they're bullish, there are now over 2 people saying they're bearish. So it's really gone down. And here at the bottom, we're showing the difference from the bullish reading to the bearish reading. And look how low that is. We're now back to where we were when we sold off that first week in August. So plenty of negativity now on from that AAII reading that has materialized itself on the ranking going that low. So that's an interesting one to watch, especially when we get into next week and see if we get some upside follow through. That's the final bar for today, Thursday, October 10th. I want to thank you so much for joining us today. You can get to us anytime, the final bar at StockCharts.com. Please send any questions your way. Tomorrow we'll have a mailbag segment where we'll start to answer some of those questions on Twitter at FinalBarSCTV. I want to thank our guest, John Kosar from Asbury Research in Chicago. This is Dave Keller from Redmond, Washington. Have a great night.